My name is Michael Duke, and welcome to my show where I talk about stocks that are interesting. So, if you find that interesting, please consider liking this video and subscribing to the channel. We are today at part two of our viewer suggested series here. My apologies, sir, if I'm mispronouncing your handle. Um, Suggested to us two tickers, one EIX, which we did a video of 2 days ago. Be sure to watch that one if you haven't. Just today, we got the article on that one published on Seeking Alpha, so be sure to check that out if you haven't. Just a reminder that my viewers get a discount on the Seeking Alpha subscription if you use the link that I have in the pinned comment and in the description. So, if you enjoy my videos and you enjoy hearing about what I talk about, then be sure to check me out on there as well. But anyways, moving on, Mr. JM Action says that his biggest speculative stock, ticker LYB. That's what we're going to be talking about today. I'm not really sure how to pronounce this name, LyondellBasell. That's got a nice ring to it. LYB. This company here makes chemicals. In fact, let's just take a look at what the description here is. LYB operates as a chemical company in the United States, Germany, Mexico, Italy, Poland, France, Japan, China, the Netherlands, and internationally. The company operates in 6 segments: olefins and polyolefins, Americas, olefins and polyolefins, Europe, Asia, international, intermediates and derivatives, advanced polymer solutions, refining and technology. Produces and markets olefins and co-products such as ethylene, aromatics, propylene, and butadiene, polyolefins, polyethylene, and polypropylene homopolymers and copolymers and propylene oxide and derivatives, oxyfuels and related products, and intermediate chemicals such as styrene monomer, acetyls, and ethylene oxide. The company also produces and markets compounding and solutions, including polypropylene compounds, engineered plastics, master batches, engineered composites, colors, and powders, and advanced polymers such as Catalloy and polybutene 1. And refines heavy, high sulfur crude oil and other crude oils, as well as refined products including gasoline and distillates. In addition, it develops and licenses chemical and polyolefin process technologies, manufactures and sells polyolefin catalysts, and serves food packaging, home furnishings, automotive components, and paints and coatings applications. It's headquartered in Houston, Texas. Interesting. Based on this company name, I would have thought that it was based in somewhere in Europe, France or the Netherlands or something. Researched later buckets for a while, and I've looked at their financials. I've scanned through their financials, and I remember there being a reason that I didn't want to buy it. I don't remember why, but their numbers didn't look very good for some reason. So today, as usual, we're gonna dive into what the company is. We're going to avoid saying their name, as we can't pronounce it very well. We're going to do an overview of the company. We're going to take a look at their market segments, discuss if they have a moat. We're going to take a look at the financials, the valuation, discuss the risk factors, do technical analysis, and I'll give it my grade: buy, sell, hold. As always, this is not financial advice. This is me just taking a look at a ticker and weighing in. So let's get into it. Because I don't have much of a knowledge base in chemicals, there's going to be a lot that probably goes over my head. I mean, just forget about the fact that I can't pronounce a lot of the chemical compounds or base chemicals there. Frankly, I don't know a whole lot about the industry. What I do know and what I can surmise about the industry is that chemical companies, particularly what I'm reading here, are kind of a proxy for a lot of manufacturing and building applications in the economy. So I would imagine that companies like this are cyclical, um, and are fairly boom and bust. And we might kind of get that picture if we look at their stock price. Hasn't really been a strong performer since it came about at the onset. What we're going to do is we're going to take a look at the Wikipedia page here just to get some context on how it was formed. So it was formed in December 2007 by the acquisition of Lyondell Chemical Company by LyondellBasell Polyolefins for $12.7 billion. 2016 is the third largest independent chemical manufacturer incorporated in the Netherlands. If it's incorporated in the Netherlands, it has that moniker. So there's a lot of context that we're not going to dive in too deep there, but accidental chemicals, each of its partners. It has some genesis in oil and gas, and I believe, and we're going to find this out here, polyolefin is a type of polymer derived from a simple set of olefins, dominant in a commercial sense. That is pretty technical, but anything with an ENE on the end, I believe, is some sort of hydrocarbon. So that ethylene is a colorless flammable gas. It's widely used in the chemical industry. So what I'm trying to say here is that any sort of chemical company it's probably going to be fairly cyclical. It's probably going to be exposed to commodity prices as a cost, and be exposed to commodity prices as a revenue item. So it's cyclical in both directions. And because what they're essentially selling is likely a commodity or commoditized, there's no moat, or maybe there's a very narrow moat given their just scale, because moat can come from scale and cost advantages too. Without doing too much investigation, again, I'm kind of doing like a first look at this company without knowing a whole lot. This is different than some other companies I look at where I'm actually knowledgeable, but I would assume for the sake of this video that we're not dealing with a wide moat compounder here. We're dealing with a cyclical industry, a cyclical company, and very volatile looking financials. So what we should do is we should take a look at their website. Let's take a look at their website and then go to the investor. You're the largest global producer of fuel ethers that help improve air quality. Chemicals we produce are building blocks for numerous products. We offer a rich, diverse portfolio of materials. So again, correct me if I'm wrong, viewers here, but polymers are plastics. Plastics are made from oil, petroleum products, along with polymers. These other, like the ethylene or propylene, ethylene, propylene, those are all hydrocarbons. So we're talking about inputs that come from petroleum, essentially. Let's take a look at most recent earnings release. Capacity and cost advantage regions. This is what I was just mentioning. That there's some interesting or any sort of advantage a company like this might have. It's purely from a cost perspective. Strategic priorities, leading market positions, growing end markets, attractive return cost of capital. I think one thing we do need to note, again, I'm jumping around here, that the yield is currently above 10%. So they're certainly not making their cost of capital goal easy on themselves there by having a huge payout. The company is well positioned to serve markets from our cost advantaged asset base. The regional cost to produce ethylene, this is interesting, widely different cost structures. Structurally low cost, globally competitive, moderate capacity expansions, maintain an advantaged North American footprint. Rationalization, high cost products include ethylene, propylene, PE, and PP. Ethylene, propylene. PE is polyolefins, and PP is I think that's what we're talking about. So this is just one of their segments, expanding capacity. maintain advantage market access. Cash improvement plan and additional initiatives for 2026, targeting 200 million in trade working capital reductions, 200 million in fixed cost reduction. Okay, so 400 million in less cash needed on hand in a given month or given quarter is what that sounds like to me. 2025 capex guidance revised down. 1.7 billion of capex. It's important to note their market cap today is 17 billion. Okay, so 10% of their market cap capex. That's the 2025 guidance. Cash improvement plan is on track to achieve an increased run rate of 600 million of incremental cash flow. Another thing kind of related to what I was talking about before, which is now worth mentioning, that it's probably pretty easy to assume or reasonable to assume that this company and this industry is fairly capital intensive. So not only are we exposed to commodity fluctuations, which create enormous operating leverage on the upcycle, by the way. So there's a place in a portfolio for this type of cyclical stock. I'm not knocking that. But capital intensity also is an element of a business that reduces its intrinsic value, in my opinion. So now it's saying, okay, that's our 2025 cash improvement, additional actions actively managing capex with a $300 million reduction from 1.7 to 1.4, including the deferral of construction for Flex 2 project. So they've put off some sort of capacity increase, probably, which makes sense because it appears that they're in the middle of a down cycle. Again, the price was $100. Further operational efficiencies from proposed European asset sales. Get rid of your high cost, low return assets. Increase the circular feedstock supply. Right size the portfolio. In other words, trim underperforming assets. Second quarter 2025 highlights: 115 million of net income. We're having some pretty big adjustments here. 34 cents of diluted earnings per share. 606 million of EBITDA, 715 million of adjusted EBITDA. But look at this: 351 million of cash from operating activities, 536 million of dividends and share repurchases. If you're a shareholder, why get excited about the fact that the business is producing less cash, significantly less cash than is being paid out? It'd be one thing if they had their dividend here and they just kept that dividend, signaled that confidence. But the fact that they're buying back shares and they're basically reaching into the treasury to do that. So we'll take a look at their debt here in a moment. But I find share repurchases here very questionable, despite the fact that the shares are very low. It'd be one thing if they were very flush with free cash flow. Here. Again. 351 million of cash from operating activity. That's 1.4 billion annualized, right? So that's like 7 or 8% operating cash yield on this current price. But 115 million of net income. Again, that's 460 million. That's 2.5% earnings yield on this price, roughly. It's like 2 something, doing the math in my head. Doesn't look good. Balancing our capital allocation strategy, our cash improvement plan is delivering results and on track to achieve 600 million of cash flow improvement in 2025. Capex planned to be 2.4 billion lower than expected a few years ago. Balanced investment and long-term value creations. Maintaining safe and reliable operations through investment in sustaining capex of 1.1 billion. See, here's the capex. Even at the lower amount that they're shooting to, multiply this by 4. Right, we're at 1.4. So even then, we're eking out a little bit more cash, and it's what's unclear here. Obviously, we know this is the number we don't want to really focus on. Net income Is that pre or post capex? I would assume it's pre. Obviously, it does appear that that includes all of these: interest, tax, depreciation, amortization here, but it doesn't include capex. Either way you dice it, the capex is eating either 60 to 70% to more than 100% of all the cash flow, right? So there's, again, I'm just kind of reading between the lines of what I'm looking at. But it seems, I like the fact that it's in really depressed valuation territory relative to maybe what it was, but, and we're just looking at the price, we're not looking at the valuation. So I want to, I guess, hold my enthusiasm there. But and I find their allocation strategy here very questionable, where they're paying dividends and these big dividends and share repurchases. I guess they're just trying to attract capital to keep their stock price up, maybe, but I find that questionable without knowing more. Again, I want to qualify all my statements here by saying I'm not very knowledgeable in this industry, in the chemical industry, so there could be an angle here that I'm missing. So I just want to be cognizant, sensitive to that. Disciplined capital allocation, they say, navigating the cycle, maintaining an investment grade balance sheet. We'll take a look at that balance sheet again. So here's our cash balance. So here's what we're looking at. So at the beginning of the quarter, they have 1.9 billion, and then they have that cash from operating activities, which again was 351. Dividends and share repurchases are dipping down. Capex dipping down, and other includes net proceeds from bond offering of 500 million. So notice how the capex and the bond offering are about the same, and our starting and ending cash is roughly the difference between this and this. Again, we'll have to look. We'll have to look at the amount of buybacks broken out versus dividends. We would have to calculate that ourselves. But effectively, they're levering the capex, which very common. You know, I'm not saying I would do differently if I'm the CFO, but we're levering the capex investment, and we're returning more cash to shareholders than we're generating. I think, just as a general rule of thumb, I don't like that. I don't like companies that do that, personally. Hopefully, it's temporary. But combine that with the fact that we've got, between this and this, we're plugging this hole with debt, and maybe it's a pretty good debt or interest rate. I don't know, but yeah, I really don't like this. I really don't like this. And so, if you're looking at, this is kind of what I covered in the last video, or at least in my article about Edison, is that, when I did a deep dive into how much their debt had ballooned over time, and they continued to increase the dividend, issue small amounts of shares, but really just issue all this debt, their retained earnings were going down, meaning that they're paying out more than they're making. And so, this right here, retained earnings are going down, right? Is what this graph says to me. Retained earnings are going down. And furthermore, when we're raising money through the debt offering, we're also encumbering the business with more interest expense. So just something to keep in mind. I'm being very critical here. Efficient cash conversion. Net debt to EBITDA. I mean, that's not bad. Feedstock, meaning energy, or what's the input, their commodity input, favorable costs. So yeah, I mean, I guess you see here olefins and polyolefins in the Americas. There's your big hole right there. How far we fell. I mean, we fell almost 70% from year to year, right, in 2 quarters. And This last quarter was an improvement. And then how about this? Woo, man, how about that? Just took a huge dive. I mean, look at these numbers. Just a substantial volume contraction. This looks better. Okay, so in every single one of these segments, this one, the trend was almost the same in that the second quarter of this year was a slight increase from the first quarter. But that we effectively peaked over the these last year in either the second or the third quarter of 2024. We have a significant drawdown. See here, some uncertainty persists. Yeah, I mean, tariff risks, I think, are present here. Advanced polymer solutions. Now that's in the other direction. We had lower sales. Technology, that doesn't look good. This doesn't seem like a very complex business, but there's enough complexity in all of the different products that I'm not really going to go into trying to forecast out the future. What I will say is that these numbers, all of these numbers look pretty bad. And it's clear that there's demand challenges across the board in pretty much every segment that they have. If you want to call that a canary in the coal mine, sure, do it. If you want to not read into it too much, do that too. I think again because we've got like chemicals going into paint, autos. We're exposed to the housing markets globally. We're exposed to the automotive markets. We're exposed to a lot of things that are under attack right now from a tariff regime or structurally higher interest rates, what have you, all that. But I will say that looking at these numbers now, I guess it puts into a little bit more context this, where this number here, where they're paying out the dividends and share repurchases, it's not really egregious when you look at it from the lens of, oh, well, just a couple quarters ago they were making that much. So a company like this, I almost would prefer that it would adopt a more variable distribution policy. I think this might be contra to me as an investor, but I really think that companies should suspend or lower payments to the shareholders when they're having struggles at the and invest more in expanding capacity or all this cost cutting stuff they're doing is great, but where's the cost cutting in the dividend and the share repurchases? That I find they're talking about how they're going to cut $600 million of their cash improvement plan. They're going to achieve a savings of $600 million. Meanwhile, they spent $600 million over a year. I mean, there's again, if I had 100% of my net worth in this stock and it was my only source of income from the dividend, then of course I wouldn't want them to cut that distribution. But it just kind of makes me think, like, is this really the right way to achieve longevity? I think that when you're the owner of the business, you end up taking the bath, not the people who show up every day and go to work, not the assets underlying the business portfolio. It doesn't mean that they can't lean out their portfolio and optimize it from that perspective. But anyways, that's just kind of my first gut reaction. Is I am somewhat encouraged by the fact that yeah, it does look like they're really in a cyclical low point here. They very well could pop right back. And if that happens within the next 2 to 3 quarters, then they won't need to lower the dividend, and they can continue to buy back the shares that they have. They can burn $200 million in cash each quarter, and maybe they'll get away with it. But what if they don't? What if we're in a prolonged down cycle, in a severe recession? Uh, Severe demand shock and supply glut due to trade international trade war. I mean, I'm not being a doomerist here. I just think that it seems like this company is really at the inflection point of a lot of moving pieces of the economy that are really sensitive to all the worst things that are happening right now. All of the things that maybe I don't want exposure to. So I'm very very much turned off by this. Looking at this, and now I'd like to just take a look at a higher level, kind of how that's trended over time. I mean, we see here revenue 33 billion in 2015 to 39 billion in the trailing 12. 22 was all the way up to 50 billion off of 28 billion in December. So you see there's just an enormous amount up and down. So from that standpoint, I think it does make a lot of sense for the management team to not get too jumpy at the dividend. They've clearly had a policy that they just kind of keep their dividend at what it is. Maybe they raise it a little bit as they ride out the peaks and valleys of the business landscape. But we see here, despite the fact that revenues have increased from 33 to 39, rounding up billion, which is 20% over that time frame, with a lot of ups and downs in between. Our gross profits have shrank by 50%, more than 50% over that time frame. So our gross profit margin today is lower. Gross profit margin has been going down. I mean, this quarter here we have about the same gross profit as we did in December 2020. In fact, we have a slightly lower gross profit than we did in a year where there was $11 billion less of revenue. I mean, that just doesn't look good, right? So the trailing 12 numbers don't look good. Meanwhile, operating income also kind of more of the same, right? We've had a gross profit go from 7 billion to 3.4 billion, more than 50% decrease in gross profit. Well, look at the operating income from 6.1 billion to 1.5 billion. That's 75% decrease. Again, it's very volatile from quarter to quarter, but um, typically when I look at these numbers here in this exact same order that I do, and I end up getting excited, it's because revenues are steadily trending upwards. Gross profit is trending upwards faster, and operating income either at about the same or even faster than gross profit. That's the mark of a good underlying business. And I'm not saying that this isn't a good business and that it doesn't provide essential products. It's just the industry, the nature of what it is, I think, leads to a lot of this. And then we see here earnings from continued operations, very, very anemic. In the trailing 12, we've had the lowest amount of earnings on record over the last 10 years. Only 155 million versus 4.5. In fact, every single year we have had more than 1.3 billion, and again, only at 155 million in the trailing 12. So that doesn't look very good, right? So yeah, earnings per share, also more of the same. $10 a share almost 10 years ago to less than $1, trailing 12. And yeah, I mean, in the meantime, they've bought back a lot of shares, 465 million shares in 2015 to 324 million shares now. Uh, I mean, the thing I will say about that's a positive is that definitely really augments the whipsaw if their revenues explode and their profits explode on a cyclical upswing. If they bought back all of these shares really cheap when they're at the lows, that creates quite the whipsaw effect. So I will say that. But here's kind of the whole essence of my criticism here. Look at the dividend. The dividend here per share. Notice how this graph is really the only, aside from OPEX and expenses and stuff, dividends and expenses are the only thing that have steadily trended upwards over that 10-year time frame. So that just doesn't look very sustainable. And you see here payout ratio far in excess of 100%. Last year it was more than 100%, and it's far in excess of 100% over the last year. So the fact that they've steadily increased their dividend over the whole time, in fact, they've strongly increased the dividend over that time. I find that to be a little questionable. It's one thing if they were paying out a dividend and just like keeping it flat or something, and it was a strong dividend too. Um, but I really don't like their capital allocation here, just based on what I'm looking at. If I look at if we move on to the balance sheet here, we do see that they happen to have more cash on hand in the last few years than they used to. It could just be we see that their cash balloons here since 2020. I think we might find out that they raised a lot of cheap debt in COVID times, which is objectively a smart thing to do. So at least they have plenty of cash. Again, we saw how the cash was trending though in those slides. So current assets, of which 4.5 is inventory, 3.2 is receivables, 1.7 billion is cash, $11 billion of current assets, $27 billion gross property, plant, and equipment. They don't have like a ton of goodwill, which is good. That's good. I mean, they have lots of assets. Current assets. I mean, what's their debt? Current portion of long-term debt is very small. Accounts payable, 3.1, 6.2 of current liability versus 4.5 of inventory. So their current ratio is fine. Long-term debt, they ballooned their debt in COVID time. I mean, a little bit. It looks like they refinanced a lot of it. So yeah, this cash build here, it appears was driven by just business strength in the upcycle, and they held on to that. So at least they've done that. At least they are flush with cash and they're distributing it slowly uh, over time. You're kind of seeing the makings of a pretty negative review here. I was expecting um, this debt line item to look a lot worse, but it really doesn't. It looks okay. It doesn't look great, but it looks okay. And then we see here retained earnings very volatile. That honestly looks a little bit better than I thought it was going to look. It's been pretty much flat for the last 4 years. Really took a dive in 2019 and COVID, which were really bad years. Um, but again, they continued to raise the dividend and pay out, and it was really lean years. We had boom years here again. Balance sheet going up again. Retained earnings here going from 4.5 to 8.5. That's about 4 billion. So the balance sheet actually looks okay. They certainly have more cash per share than they did before, and the book value per share also looks not bad because again they've got all this uh, gross property, plant, and equipment, net property 17 billion. So given the capital intensity, probably lots of real estate, lots of equipment, um, lots of infrastructure. That stuff does have value. Again, I assume that's all carried at cost, but they can sell stuff off if needed to. In fact, that's what they're doing in Europe. So their income statement, I give a very strong thumbs down on that. Their balance sheet looks okay, doesn't look bad. Uh, I think the main thing that I'm struggling with here is capital. In terms of their valuation, kind of a mixed bag. I feel like price sales and price book are good ways to value this company because they got a lot of hard assets, because they're cyclical. I wouldn't even look at earnings really. Price earnings, I'd look at price sales. From that standpoint, price sales, that looks really good. Their price book doesn't look bad at all. I wouldn't necessarily call it like a screaming deal. I would love if this company was it had more cash than it was worth, but we're just not at that level of value here. But yeah, I think the valuation is pretty good. We see here valuation is given an A grade, and again, I think price sales is really what's driving that. I mean, even at the lower sales levels that it has, the severely lower sales levels that it has, we still have a lower sales price sales ratio than typical. Typically, over the last 5 years, it is below one, but it's not that severe. So I think that's a positive there. Let's do a quick technical analysis, and I'll give my final thoughts. I mean, I'm hardly even diving into the cycle, the products, any of that. And mainly the reason for that is because I've seen enough at this point. But let's just dive into the technical analysis. I mean, you see here, pretty interesting looking chart. We had this pretty bad, kind of got this trend line going on here. Temporarily broke out of it really not that long ago, in July, mid-July. But more or less, this very weekly has been a downtrend line here. Again, it was starting to recover. It was starting to recover here, right? And it broke above, and then something happened here. I wonder when August 1st, the earnings that happened right there. So kind of around that time, August 1st. So right around the earnings. So they dropped all the way down, below $50, below where it is now, and it started to recover. And it got a little hot, but then for some reason it broke down below that channel and all the way back down to almost $40 a share. And we've since recovered a little bit. The chart also just does not look good. I mean, we're basically in a descending downward formation here, and we're near the top of the range. I find the current price action where it's at now to be very tenuous. Um, if for some reason it were to break above this trend line here as it did before, look how much it dropped in. I don't know what these are 4-hour candles here. So it dropped from 65 to 55 ish in 8 hours of trading time. It was much lower, another $10 lower within a week. I find the current level that it's at now to be fairly tenuous. Otherwise, meaning, if it was down along this base here, that might be something to get excited about because it's clearly held up. Again, just you see the volatility, this severe volatility in this down cycle. If it was down along this area here, it might be something to get excited about. Or if it was above this line on volume, some sort of news, to act as a catalyst, that might be another area to get excited. But where it's at now, I see more downside than upside risk in a very, very immediate term. So that'll be our technical analysis. My grade on this is avoid, hold at best. If you're in it here, hopefully you know more than me because I'm qualified throughout. There's a lot that I really don't know or understand about this industry, about where we're at in the cycle, about any of that. But just mainly focusing on the objective qualities of the business, the capital, understanding that they're in a low part in the cycle, and really zooming out and looking at across multiple cycles now how they've handled capital allocation. I think that's probably the biggest demerit in my mind that I see with it. So I think on that alone, it's an avoid for me. If you're comfortable with that and have the belief that they're going to continue to pay out that, I mean, they've certainly paid out that dividend and continue to increase it all throughout many cycles. And so if that's all you care about is just collecting a coupon, you think, you don't mind that maybe they're going to continue to raise debt to do that, or however they're going to do it, or maybe it stalls, and you're not really too concerned about the sustainability of the dividend, and it's more about I'll collect this coupon and then they'll get back to a cyclical high. That could be a pretty good trade, actually. That could have a good return. I really don't like to buy things that I'm going to only hold for a trade like that. That's not my style. But if it's yours, I can see how it would actually produce market-beating returns. But then, it's unclear how far it can fall in the meantime. It's tough. Cyclical stocks are really tough. but they do produce pretty generous returns when they're gotten right. So from that angle, I can see why it might be a compelling play, but for me, it's an avoid. Hopefully, you found this interesting, insightful, and entertaining. I certainly have, enjoyed walking through this one for you. Again, thank you to Mr. JM Action for giving us that suggestion there to take a look at this one. Um, he said it was his largest speculative holding. Wish him the best of luck on this. Again, I think it could end up being a phenomenal return over a short amount of time. I don't see the catalyst, and nor do I understand. So I don't like to invest in things that I don't really understand, and I don't fully understand this one. But what I do understand about it is that the way that they manage their money is a little concerning to me. So that being said, that's why it pays to have your own style in the markets. So again, thank you for watching. If you found this interesting, please consider liking the video, subscribing to the channel. Um, I'm gonna make some lunch now and get this uploaded so you can all see it. Thank you for watching. Until next time, have a good rest of your day. Bye.